Adjunct Professor Moran, Microeconomics. Wonderful. Doing a thorough discussion of microeconomics by discussing taxes. Alright, taxes are a charge the government levies on people. And there are many types of taxes. There's an income tax, sales tax, lump sum tax, user taxes. Tax burdens do not fall evenly on all incomes. There are basically three different types of taxes in terms of their impact concerning income. Proportionate, also known as a flat tax, is the same percentage charged regardless of income. So 10%, everybody pays 10%, for example. A progressive tax is a tax where there are higher percentages charged to people who have higher incomes and lower percentages charged with people with lower incomes. A regressive tax is a tax where people with lower incomes actually end up paying a higher percentage than people with higher incomes. Let's take a look at these tax rates and pick some examples. All right, let's say someone has an income of $100,000, $70,000, and $40,000. And let's say there's a 10% tax. Okay. We're going to ignore consumed and saved for this. We'll discuss that when we talk about a regressive tax. So here, this person, if they were taxed completely on income and there were no deductions, this person would pay a tax of $10,000. This person would pay a tax of $7,000. This person would pay a tax of $4,000. Each person is paying the same percentage. Now, the people who are more affluent pay a higher dollar amount, but they're all paying the same percentage. That's a flat tax or a proportionate tax. A progressive tax is when the tax percentages change based on income, with higher income people paying a higher tax rate. So let's say the tax rate did that backwards. 20% on the affluent, 15% on middle income, and let's say 10% on this group. The higher income person would pay $20,000. This group would pay $8,400, and this group would pay $4,000. So the more affluent pay more in dollars and also more in percentage, and that's a progressive tax. The federal tax code is set up to be progressive, theoretically, where the higher income you have, the more tax you pay. However, the more affluent you are, there are deductions from income that you can claim, and the more affluent you are, the more deductions you are likely to have, which reduces that explicit tax break. The tax percentage it puts the deductions will put a person into a lower tax bracket. All right, aggressive tax is a tax that falls more heavily on the poor, and here we have to consider how much of your income you spend and how much of your income you save. So the progressive is like an income tax, a federal income tax. State taxes tend to be more regressive. So when you combine state and federal and local taxes, the tax code of the United States is slightly progressive. Now, a regressive tax, let's say this person has income of $100,000. This person has an income of $70,000. This person has an income of $40,000. Okay, now there's a concept called average propensity to consume, and the more money you have, the more able you are to afford savings, for example. So let's say this person's average propensity to consume is 70%, and this person's average propensity to consume is 80%, and this person's average propensity to consume is 90%. You might remember this from macroeconomics if you've taken macro. That means that this person is consuming $70,000 and saving $30,000. This person is consuming $56,000 and saving $14,000. This person is saving $4,000 and consuming $36,000. Now, a sales tax, which is a regressive tax, the amount you pay when you buy a good. In New York State, I believe it's about 8.65%. So the maximum the state charges 4%, and the maximum that counties are allowed to charge is 4.65%. And lucky for us, we're in a county that charges the maximum allowed by the state. So that's your state sales tax. For simple purposes, let's assume that the sales tax is 10%. This person would pay 10% of only the amount they consume. You don't, since you're not spending it, you don't get taxed on that. So $30,000 or 30% of this person's income escapes taxation. So that would be 10% of $70,000. That's $7,000. This person is paying 10% of what they spend, which is $56,000, $5,600. And this person is paying 10% of the amount they spend, of $36,000, which is $3,600. Now we're going to figure out the effective tax rate. How much is this dollar amount tax actually a percentage of how much their income is? So this person is paying a tax of 7% on their income because $30,000 of it escapes taxation. $5,600 is what percentage of income of $70,000? That's an effective tax rate of 8%. And $3,600 is what percentage of 40,000? Clumsy fingers. 9%. So you can see that the tax burden is actually falling more heavily on the less affluent because less of their money is escaping taxation, because the less affluent you are, the higher the average propensity to consume is. And that's a regressive tax. So for example, the federal tax on gasoline is about 18 cents. And in New York State, the tax on gas, I believe, is around 45 cents. So that's 63 cents about of every gallon that you buy. The price of gas is 63 cents. If the gas is $3, that's a 20% tax rate on gasoline. It's quite a regressive tax. All right. So that's our discussion of tax. Now, who pays the tax? The producer or the consumer? And it will depend on the elasticity of demand and the elasticity of supply. And if you remember from our discussion of supply and demand, elasticity is how responsive quantity is to changes in price. Here we'll hold supply constant and see what happens. Who pays the tax? So this would be S1 without the tax, and this would be S2 with the tax. And here's an elastic demand curve, and here's an inelastic demand curve. Okay. When a tax is placed, this vertical distance is the amount of the tax. And that's going to be split between the producer who will pay part and the consumer who will end up paying part. So here's our original equilibrium without the tax. And here's our equilibrium with the tax. Here's the price of the good without, and here's the price of the good with the tax. Okay, this vertical distance is the amount of the tax. The consumer will pay the tax on this much of the tax, right? This is $2, dividing point, on this many units. So the consumer is going to pay this amount of the tax. It would be the area of this rectangle, this height times that width. The producer is going to pay, this will be the demand paid by the demander. This is the amount paid by the supplier. This rectangle. They'll pay this much of the tax on this many units. That's because demand is elastic, and when the price goes up, consumers, for example, can substitute to other goods. So most of the tax will in fact be borne by the producer. But when demand is inelastic, like gasoline, then here's the tax, here's the price without tax. Vertical amount is the amount of the tax. That is in effect a cost of business. The business will raise its price as a result, price with the tax. We're going to shoot a drop down line to S1. Yeah. Okay, and come over. And you can see now that demand is inelastic, the consumer bears most of the vertical distance between the two supply lines. Most of the tax will be borne by the consumer, because the consumer has no substitutes, it's a necessity, whatever. The consumer isn't reacting as much to the change in price. And as a result, the producer will bear less of the burden of the tax. This much tax per unit on this many units for the producer, this much tax per unit for the demand, the person demanding, the supplier. That's the dividing line. So when demand is elastic, most of the tax will be borne by the supplier. When demand is inelastic, more of the tax will be paid by the consumer and less by the supplier. Let's look at supply. Change the supply elasticities here. So here's supply elastic. And here's demand. So the tax is in effect a cost on the supplier. He shifts the supply curve to the left. The amount of the tax is this vertical distance. This is quantity without, quantity with the tax. This is the original equilibrium. This is the price with the tax. Okay, this will be the amount of the tax paid by the producer. And this is the amount of the tax paid by the consumer. So when supply is elastic, more of the burden will be borne by the consumer. The demand and the producer pays less. When supply is inelastic, quantity without tax. Well, perhaps you couldn't see that. Okay, so supply elastic. More of the rectangle, more of this area is borne by the consumer and less by the producer. The vertical distance is the tax. The tax paid by the producer would be this distance, this entire distance is the amount of tax, times that number of units. For the consumer, it's this distance times that number of units, and that gives you the area of these rectangles. Now, when supply is inelastic, shoot a line over. This is the price without tax. This is the price with the tax. Go down to the original supply curve. This is the amount of the tax per unit that the producer is going to have to pay. And they'll pay it on this quantity. So you can see that when supply is inelastic, the producer will pay most of the tax, and the consumer will pay less of the tax, read from the demand line to the original equilibrium. So this vertical distance is the amount of the tax that has to be split between the consumer, read from the demand line, and the producer, read from the original supply line. Now, economists are really not happy, theoretically economists aren't happy about taxes because we want to satisfy as many wants as possible. Because the equilibrium quantity is falling, not as many goods are being exchanged. And this rectangle here, bounded by the original supply line, the demand line, and the amount of the tax, is referred to as a dead weight loss. Some textbooks call it something else, but I like it. It's also called an efficiency loss, but I like the word dead weight loss. So this is an amount of trade that will not occur because of the tax. Here the dead weight loss is the along the new quantity, the demand line, the supply line, the old supply line, and demand line, and that's an amount of trade that won't be happening. And in our last video together, we'll discuss, we'll take a high-level look at the tax rates in the United States and where the burden is falling, at least at the federal level.